SoFi Technology sell-off after double beat, guidance hike, another opportunity SoFi delivered again, and Anthony Noto and team did a phenomenal job at Real Map Money, future investing, fun of investing, and crossroads. That is myself, Matt Money, Tevis, and Roy. I'm offended you didn't at me. No room.
No room.
I didn't know I would have been cut so deep. Anthony Noto said, personally, I would have included you. Ooh, that's gotta hurt, Steve.
Can't believe it.
Can't believe it.
Can't believe it.
Big up to Anthony Noto for involving a little bit more in this small little investing community.
Where is Hager, by the way? I thought he was coming.
No, I think he's busy. He's traveling, I think.
He heard you were on, and he's like, dude, you know,
I don't want to talk to that guy.
Boycotting Steve.
Yeah.
That's fine.
Ladies and gentlemen, welcome to the SoFi Weekly. SoFi had just had earnings. It wasn't like what we were expecting, being up after SoFi presented their normal triple beat. This time, after our triple beat, we went down 10%. Overall, your reaction, was it justified?
No, it's a triple beat. Stock had not had a run up before other than aftermarket. The 10% drop wasn't justified. The actual results, really, really good.
I feel like people are harping on the quarter over quarter guidance. And meanwhile, like management guided for what the year was going to look like. I don't see any huge variance to that guidance. And they raised the end of the year guidance as well. So if you're looking for an excuse or if you're looking for a reason to sell the stock or, you know, adjust your price target downwards, every single earnings call, you will find something. It's just, is it material enough to actually make a difference in your thesis? And in this case, I don't think it is.
I mean, look, obviously, I think that the market got it wrong. And I think the real question is, did anybody besides me buy?
A little bit, just a little, tiny bit.
It's very hard to take this seriously. Since I am not a short-term investor, I could care less. Who cares about quarter over quarter? And I know people are looking at this saying, oh, but the quarter over quarter revenue, this will be the second quarter, it's decreased. Who cares? You got full year guidance that got increased. And I think the problem now is that the market has gotten used to Noto sandbagging and them coming out with triple beat after triple beat and raising guidance. And maybe that's working against us right now. Looking at their full year guidance, this is good guidance. And ultimately, when you have more members coming on the platform and deposits growing, it's hard to say that they don't have a good product that's valuable. It's the barometer that I'm using.
If you're an analyst who has historically always viewed SoFi in the lens of they're a lender, this is now changing that perception for you because the non-lending segments are a stronger contribution to the revenue mix. It forces analysts to look at this company in a more dynamic lens. Ultimately, the lending segment is flat to down. And if you're always looking at it from that traditional point of view, you can obviously be more bearish than normal. So my point is from an analyst perspective, like I understand how they can paint it from a bearish lens because they have historically always judged SoFi from the lending perspective. And now that dynamic is changing. The story is changing.
I think the market's wrong on it. I'm adding when I'm able to lower my cost basis by a decent amount, which I was able to, but those days are getting very slim. And I think this is something you have to either believe in the long-term thesis or you don't.
We've been so range bound from a stock perspective for so long. I understand the pendulum swing of saying, okay, we don't want a management team to overpromise and underdeliver, building up hype just for the sake of pumping their stock. And then on the complete other side of the spectrum is SoFi that plays their cards super conservatively, even when in many cases they might not have to, because they could absolutely take a more risky approach and come more in line with what the base case is going to be, but they go super conservative relative to that. Looking at all of the comments and reactions from the earnings, it's so evident to me that a lot of people just are not thinking about this from a multi-year perspective. They're thinking about this from a much shorter time frame. There's so much downward pressure on them because the stock has been trading in such a range for a long time that all they need to do in the short term is build up that excitement to the point where this thing breaks that range, and so that the psychological downward pressure is broken, and then it can be business as usual, because right now we're getting into a further disconnect between the company fundamentals, which are continuously executing, and the actual stock, which is stagnant to down.
And that's an important point because the stock and the company are two different things. We are on track to continue hitting the metrics that they're setting forward. I think that when they're guiding 8-9 cents this year, that really means 11-12 cents or 13-14 cents this year. That puts us on track to hit 55 to 80 cents. And that's a big range. But that's the range we were given. I gotta think we're going to come in the midpoint of that somewhere in 2026. And if you do, you're talking about trading at 11 times 2026 earnings at a midpoint, maybe even high single digits if they continue to deliver on their critical success factors. From a company standpoint, they're doing everything they need to do. Right now, there's a disconnect with the stock, which is okay because you know what? Stocks don't go in a straight line up. Sometimes there's a lot of pain.
And I don't think they're going to come in that 55 to 80 cent EPS range in 2026. I think they're actually going to beat that range because that range forecast doesn't account for new product lines. It only accounts for the organic growth of the existing product lines. The problem is that it's very difficult for people who are not as in the weeds as we are to see the path forward of how we get from point A today to point B in 2026 and what happens in between that time. There's execution risk baked in. There's expectations on management to continue to deliver on new product lines. We're confident in because they've done so in the past, but because we've been following them. But somebody who's done maybe 2 hours or 5 hours of research into SoFi might not have that level of confidence that we have.
And I think it's, do you have 5 years? Because if you have 5 years, this looks really interesting because there's a lot they can do in 5 years. There really does look like a very long road of growth ahead of us. And I understand the RFP process, but at least tell us what large regional banks signed on. I get it. You can't tell us who you're currently in an RFP with, but they got to show some movement on that because that's what's going to give them the hybrid or a tech multiple. Otherwise, it's going to be hard to really get them out of this whole framework of being just a bank until they can really show off and showcase the tech platform.
You don't even necessarily need to show anything with the RFPs if they didn't want to, as long as it's coinciding with revenue growth or margin expansion or something along these lines. Some of the comments regarding growth in Galileo, the pipeline being extremely strong, are so repetitive without actually seeing results. I don't necessarily think that the market cares that the pipeline is as full as it's ever been. The fact that they're simply not growing as fast as people want them to is what's holding them down.
Well, and keep in mind, we understand Galileo, we understand the RFP process and technesis, but the average person that doesn't follow SoFi as closely as us, this is speaking a different language to them. And I think that they need to do a better job of really outlining how critical these components are and why they are going to be the AWS of fintech and what these companies allow not just them to do internally, but what they allow them to bring in from a revenue standpoint externally. I just don't think that a lot of the analysts on the street actually understand this, and I don't know if they're really looking into it. I am still very bullish on the tech platform as I don't think people understand. A lot of banks have been engineering their tech platforms internally, and they're going to need to go to a cloud-based platform. There is a ton of new regulations coming down the pipe. There's only a handful of companies that are going to be able to provide this. SoFi is one of them. This could be absolutely huge.
This slide has nothing to do with SoFi, but it's how I would like to get some clarity on the tech platform. This is from a company, Innovix. What this basically was is pre-production phase for Innovix. They're gearing up manufacturing lines of different things. They had some really neat features. So they ended up key coding all of these. So you can see the different colors. You got the different market classifications, so you kind of know what product it is. And then you have the account code here that goes along with the number. So you'd actually see where clients move through the funnel. Down here, the funnel milestone would tell you how many units were actually in production. So engineering sample, just like 10. And then also a milestone duration. So it tells you like 3 to 9 months, 6 to 9 months, 4 to 6 months for each phase. So you can kind of get an idea of where you're at, what kind of products, that they're actually looking at from Galileo. It's not easy to do, but this was, at least for me as a shareholder of Innovix, was invaluable because it helped me, first understand before I got in there, is this just all smoke and mirrors? That's what people are wondering. But a lot of people are wondering, like, what kind of products are people looking at? What kind of customers do you have? How long are your phases expected to last? How are these companies moving place to place in that pipeline? I don't think this would pump the stock, but it would give us a lot more information as investors. I would find that very helpful rather than just occasional updates.
Could be good. I don't know why they're not giving more information happens. It's just speculation at this point. So I don't know.
What is the purpose? What is the end result that they're trying to provide for that? If awareness, why and to whom? What does it benefit for SoFi to provide this? They now have a more scrutinous lens by which people can judge their success or failure.
I think that that's the wrong way to think about it. I think as investors, it's not about, you don't want to be behind a stock that is being pumped up either. You want to know what the red flags are. If things are turning sour at Galileo or something like this, it's very important, even then, to showcase that things are turning around. So then you can make that decision to potentially sell, not other investors. I'm talking like literally me and you.
First of all, many of the analysts discount the technology platform because it's not a big contributor to revenue. And so if Galileo client pipeline was low, let's say, well, Galileo only does like 94 million in revenue anyways. It's like a third of what the lending segment does. It's half of what the financial services segment does. And so analysts will discount it. And for the retail crowd, Galileo is really a symbolic directional play that's multi-years out for it to, actually play out in the growth story. It's not like this quarter for next quarter. What is the pipeline going to be looking at?
It helps differentiate them from being valued as just a traditional thing. Most of the people probably don't even realize that the combination of the two saves SoFi between 65 to 80 million a year in expenses.
Well, all they're going to see, or at least what they're going to lead with, is the revenue or lack thereof of the technology platform, the percentage of the revenue mix. If the tech platform in a parallel universe is 50% of SoFi's revenue, analysts will judge it way more as a tech company than today when it's a fraction of the total revenue mix and it has granularity in terms of the pipeline. How big of a contributor is it to revenue is the main parameter by which analysts are judging whether it's a bank or a hybrid.
There's three main segments for SoFi. This is one of them. It's one that we know very, very little of. And if it's actually significant to their future, which all indications from the way they talk it is, them continuing to just, have these very obscure timelines and information is not helpful to take that credibly. And yes, revenue is most important, but I don't blame the analysts at all for discounting this and just saying, you know what? Maybe we'll give it $1 for the tech platform, and that's it, as far as price target.
They just have to do a better job of showing the potential of what it can become and what steps they're taking to make it become that.
I think the earnings call shows you what they are planning on pushing. It's not business banking and it's not lending.
Credit cards.
Credit cards, exactly. What people are arguing about in the stock price, I think people are not pricing in what credit cards can do for the business. And that sounds like a small product for SoFi right now, but there are a lot of companies that have built massive $50 billion, $100 billion companies off of that product alone. And now SoFi is saying that they are getting enough of the data to actually start ramping this. They're going to start increasing it on the back half of 2024. The defaults are coming down drastically, potentially one of the highest ROE products that they have in their entire list of products, including personal loans. I don't think you have to look too much further than the things that they already have on their shelf right now. I think that the stock can turn around with the products that they have on shelf, and that's SoFi Money, SoFi's credit card, and personal loans.
They know what products their members are in line for and what could help them, and they can push those promotional products to them.
If we have a very low bar for credit cards, which we shouldn't, I think this could be profitable. There's no reason why it can't, especially with the data advantage that they have. If they're just trying to cross-sell that to their own members, they know people because they're like, hey, we have your bank account, we have your direct deposit information, we know your income, we know your credit score, so have a credit card, and we feel pretty safe about offering you this. Very low bar. I believe it's $100 million drag. If they can just
$100 million annualized between invest and credit card.
But if they can get that drag, that's a huge increase. And that's not like a very high bar of difficulty to just get a net zero on invest and the credit cards.
So I think if we talk about credit card, the interesting thing that Anthony Noto dropped in the earnings call was that we can expect some more innovation in credit card product in the back half of the year. That was his wording, essentially. Expect more innovation in the back half of the year. But I'm just looking at the earnings release. The defaults are going to come down as they keep growing. It's going to be a profitable product. Credit card is still 10x smaller than invest. It's still 20x smaller than money. And that would be fine if it was the fastest growing product. It's not. Referred loans is growing faster than credit cards. From a percentage point of view, referred loans grew 34%, credit cards 32%. Invest was flat. I mean, they're also investing in invest, and invest is flat as well. Money is the main thing that's growing fast, and it's also their largest aggregate from a product perspective on financial services. So
I think you're brushing past the idea of it being for second half of 2024. I don't think they're currently, I think they're in the learning phase still.
Sure, but it's going to take a while to get there, is what I'm saying. It's not going to be something that's going to materialize this year, even if it is Q3 or Q4 this year. Fast forward to December, I don't think we're going to see, credit card making a surprise comeback. It's going to be probably a 2025 thing.
Can the SoFi credit card compete with Robinhood Gold?
I don't think that that's an appropriate question.
It's a legitimate question. Can it compete with Robinhood Gold? Because if somebody is going to sign up for a new credit card, you have options.
It's not so mutually exclusive, because the amount of people that have multiple credit cards is like, there's no barriers to entry. You can have both. You can have
you guys seen my background? I've got like 6 here.
Yeah, that's the thing, is it's not winner take all. If it was, Robinhood Gold would win, would trounce everybody else, and Robinhood might go out of business.
Capital One would go away.
It's not winner take all, but there are more options today than ever before. All I'm saying is, can the SoFi credit card compete with Robinhood bringing their product out now? The credit card aspect doesn't even compute into my stuff right now. It's the least thing I'm excited about.
No one's talking about spend on SoFi. And the numbers that they are coming out with are insane. It was probably the most exciting beat in the entire quarter. Although it makes up for a nominal percentage of the overall business right now, SoFi Money added 500,000 new accounts. And that is on top of, that is inclusive of the people who actually closed their accounts. They said overall debit transaction volume exceeded 1.9 billion in the quarter, up 20% from the prior quarter and up 150% year over year. On their forward-looking guidance, they said you could expect the same relative linear growth with spend over the course of 2024. So that's 20% per quarter for the rest of the year. Financial services is going to make up for such a large percentage of this company. And I think it's going to change the way that people value this company, because it's going to reduce risk on lending. Everyone wants to talk about the tech platform, and the tech platform is exciting in principle, but not in growth rate. Right now, I could care less about Galileo. I care about SoFi Money and the financial services platform. It's booming.
Financial services is right now the most exciting thing about this company, because it grew 86%. And they're saying over 75% is what we can expect going forward. So the technology platform, like I said before, it's 94 million in terms of revenue. It's exciting if I look 2026, 2027, what it could become. But in terms of the actual growth rates right now, like, money is carrying a lot of SoFi from a products perspective, especially when lending is not going to be there to have that growth rate. Financial services is going to quickly catch up.
I actually have a big problem with this members page. And I don't know if the difference between 7.542 million and 8.132 million is not 622,000. It's like 580 something thousand. They are covering this large ad, but it's not inclusive of drop-offs.
Yeah, they need to include that line. New members is fine, but have the drop-off line just so people can see it. It's more transparent.
They should have a new member line and a net member line is what they should. But when you look at this, the fact that we continuously add, and this was the second best quarter for new member ads over the trailing 12 months, you have not had a quarter under 575,000. You never had a quarter of 575,000 new ads pre the past 4 quarters. And then you look at the correlation between new member ads and deposits. You had 2.98 billion in new deposits over the past 3 months. They're growing at a 16% year over year or quarter over quarter rate from Q4. When you look at the way that this is going, if the product wasn't adding value to individual member lives, they wouldn't stay on the platform. Or would they get these ads? Like, these members are most likely coming due to word of mouth or somebody knowing somebody that's happy with the product. Some are probably coming from the advertising ventures with the NBA and the football stadium, but this is who we need to be listening to, not our opinions or other people's opinions about if the product is good or not. The people that are using the product and sticking with the product and growing the product.
100%.
If you go to products for a second, I mean, to Steven's earlier point, I think it's important for us to call out where we're seeing the majority of this growth and use that as a lever to try to make some assumptions about that growth going forward. Money added on a year over year basis about 1.5 million products, and Relay added about 1.4 million products. Just those two is like 3 million products. And so looking at this, chart, you're at 11.8 million. If you just consider the growth in money and Relay, those are the two individual line items across the entire business that are adding more and more and more on an aggregate basis. And so every quarter, as you look at that financial services productivity loop, money and Relay are going to become a bigger and bigger chunk of that pie. There's good and there's bad. With that, the bad is that obviously we don't make as much money from those segments. The good is that those segments are low barriers to entry product lines that introduce people into the ecosystem. And so how that changes over the course of the year, I don't think it's going to be anything drastic, just because those products are easier to set up for users than anything else in the ecosystem. You're more likely to set up a Relay than you are to get a mortgage.
With SoFi Money, the funniest thing about this product is that at first glance, 2 quarters ago, we had no idea where the margins were going to lie because we're in negative contribution margin for financial services. In the matter of 2 quarters, we went from 3% contribution profit on SoFi's financial services, which is essentially all SoFi Money. Then we went to, 18%? Then the next one was 25%. That was the most recent quarter. The reason why I'm bringing this up is that that's inclusive of the losses of SoFi Invest and SoFi Credit Card. So the potential margin on SoFi Money could be as high as freaking 40%. Like, we don't know. So as those turn around, right now they're holding negatives. They could not only just get to break even, which would put a massive positive impact on margins for SoFi Money, but also if they start to add new potential profits, that's going to be a multiplier on their contribution profit going forward. So we still have so much margin expansion on those products. I don't necessarily think seeing SoFi Relay or SoFi Money as being the larger contributors is necessarily a bad thing. They're potentially higher margin than Galileo and Technisys.
I know earlier in this session, you guys basically have had an ask for management to provide more details around the technology platform pipeline. I think if I could have a wish list item for management, it would be cohorts, to see how the cohorts every quarter break out, because that would allow me to judge over a course of time, let's say 3 years, which cohorts have expanded more to cross-sell into other product lines. And that would be a really interesting aspect to break it down by.
Yeah, you set it up as a quarter over quarter bar chart. I mean, it's just brilliant idea. Love it. Palantir used to do it. Wish they would bring it back.
Let's focus on the things that they're doing right now. G&A, sales and marketing, technology development, across the board, expenses are coming down. The largest bear case 2 years ago was Anthony Noto's compensation.
Stock-based compensation.
Stock-based compensation. It was 20+% before. Now we're less than, I think it's like 8.5%. People are so focused on the overall stock price, but it's like, why don't we look at the things that are actually improving? Like, this company is getting better and at cheaper prices.
The reason why the numbers were softer than I hoped was because I didn't take them at their word that they were going to deliberately be very cautious on lending. They kept their word. Chris Lapointe had a good point. They're not capital constrained at all, that they can loan up to 20 billion, or they can originate another 20 billion in loans without even coming near the limit throughout this year. And, of course, they tend to be a little bit more cautious on that. So I expect it's, an even larger number than that. At some point, if they just decide like, hey, you know what, there's a loan demand out there, we can make just an incredible amount of loans, that will be a face ripper earnings. And it's their own choice and their own caution. And so it's not like, that they're trying to sell these loans and nobody wants them. They want them. And SoFi's like, well, no, too bad. They're ours. We're not going to sell them to you. The moment that changes, the trajectory of this company changes immensely.
But I was fairly annoyed that people are overlooking the guidance bump that we got. And when you look at this is a big bump from the prior guidance. A lot of people were pretty ecstatic with the guidance that we got a couple of months ago. Not only did we get a bump across the board, you got margin increase on net income and diluted EPS. I mean, this is pretty phenomenal here. You can't deny that everything continues to work out the way that they envision it. You have an annual growth rate on revenue that's going up. you're at a 25% adjusted EBITDA margin, and in 2022, it was 9%. If that's not progress, I don't know what people think progress is. I mean, this is a company that hasn't even hit its maturity yet and still has a lot of levers it can pull, still has a lot of products they can put into development and implement. And this really is a strong foundation of what the future could become. And I think people need to start taking the guidance more seriously. And this, once again, is a segue to that 2026 number that everybody thought was bullshit when he gave it on the earnings call. I mean, you had prior guidance of 7 to 8 cents diluted EPS. It's Q1, and they're already increasing it. You know you're going to get another one next quarter and another one after Q3. This number is probably going to be anywhere from 11 to 13 cents for the end of the year.
I think it was a serious miss on Anthony Noto's part to not reiterate the 2026 guidance.
Same exact way that they kept hinting and saying in Q4, got profitability.
They said, if we lean more to the conservative side, we can always go up, but we don't have to go down. They're leaving themselves that leeway to change their mind going forward.
I went back and I looked at the analyst expectations for Q2 revenue. Analysts forecasted out. You remember that chart I showed you guys that showed EPS that was like 0.00 whatever? It went out as far as Q2. In Q2, the revenue estimate, the top line estimate for analysts was 575 million. Here, the guidance that they're providing for Q2 is 555 to 565. In other words, they would have to come 10 million above the top end of their range just to meet analyst expectations for Q2. It's a high lift for us to expect them to beat in Q2 because their range is under what analysts are currently expecting for Q2.
But that's already priced in. That's why the stock is going down. I think that you'll see analysts revise their revenue. I think that it's probably best to just add the two together because the large beat in Q1 already.
Like ultimately, none of this matters because they raised their guidance for end of year and we can trust that. But from a perception point of view, if you think 10% downwards move was bad on a triple beat, imagine when they don't do that.
It was good numbers, just not what I wanted from the earnings call itself. More information is better. I don't like when questions are dodged. So I feel exactly like I did with PayPal's previous quarter. I hold. I'm not going to add. So I think SoFi next quarter may, do quite well, give us some more information. And at that point, but I'm like the market. I don't like what I don't know. There's no certainty there.
But until next time, hopefully you guys enjoyed the SoFi Weekly. Many more videos for me to come. I'm not taking another week off. Bye for now.